Item 13, Mike Moy. I got it, Danielle. See, I'm learning. Private equity semi-annual performance report.
I'll be very fast since it has been a long day. The performance report starts on page 2, INV 270. I'll just cover 3 or 4 items. You will notice in the report the continuing difficulties that we have with the benchmark and your performance against that benchmark. I would argue that the problem is the benchmark, not the performance. But I think that's, to me, is an industry-wide problem, and finding an appropriate benchmark that really gives you the ability to measure success currently and in the long term. I think you really have to look at it on an absolute basis and make certain that it's contributing to your expected performance that's in your asset allocation. You will notice that the NAV of the program has diminished by about $1 billion from the 6 months ago. And that is caused by the level of distributions which have been occurring. And the managers have been relatively prudent in terms of investing in new portfolio companies. And I'm going to guess that that's probably going to continue for a while, but it is going to be a problem to get to the 13% allocation. And cash flow has been positive since 2011, substantially. That will just end at a point in time. Don't know when it's going to end. Probably pretty quickly, given what's going on in the markets. My guess is that'll have a ripple impact on what companies can be sold for. The rest of the report is pretty, I'm going to say pretty plain vanilla, particularly given all of the conversation this morning that you all had. And I'll be happy to answer any questions.
Any questions for Mike? Seeing none.
I'd like to take a moment of personal privilege and just
And
say,
I would like to take a moment of personal privilege too, so you go first.
say thank you to you all. This is my last performance report. I've been doing this for 8.25 years. It's been a true joy, and I wish you success in the private equity area.
And I wanted to say, as Chair of Investments, Mike, how much we just respect and appreciate your opinion, the way that you've advised our board in this challenging, as we've underscored today in the conversation, the challenging asset class of private equity. And so just have a lot of respect for you, and thank you for your service to our board. We really appreciate it.
Thank you.
And I think Mr. Keeley has a word as well.
Class act, Mike. Thank you very much for your
Absolutely.
comments. That's a class act.
Go Jets.
You guys are dreamers, real dreamers.
We are.
Dreamers, I love
Sometimes they
it.
come true.
Well,
Sometimes they come true.
One can only hope. Chris.
So sorry to ruin the good mood. Just INV 281. I know we can't bring it up on the screen for the public, but
Are you
that.
still on item 13? So
Yes,
you're, okay.
INV 281, the upper left-hand corner, that would be my most frightening chart, number 2. This is kind of the opposite of real estate. This is prices paid. What do you have to pay to invest and buy a company in the private market today? You can see that in the first half of 15, it was 10.1. That may not go down now thanks to the summer, but basically, new investments in private equity, we're having to pay amongst the highest prices. So both, and PCA pointed that out on their other chart, that both private equity and real estate are priced almost to perfection. That's a good way to put it. So it's a tough time to make investments and to hope we make money.
Thanks, Chris. Our item 14, I know, has sort of been pulled for until next meeting. Is that right, Chris? 14? So given that we've had a conversation with private equity, I know we have a speaker from the public that wants to speak related to private equity. So why don't we go ahead and take statements from the public now, if that's amenable. We have Denick Murphy here from AFT.
Thank you, Madam Chair. Members of the board, Caliper staff, my name is Denick Murphy. I am speaking on behalf of the American Federation of Teachers, the California Federation of Teachers, about 100,000 members strong in the CalSTRS system. We want to thank the board, and especially Chris Ailman and his investment team, for their continuing efforts to ensure the retirement security of our members and all California educators. Your efforts are genuinely recognized and appreciated, especially during a very challenging fiscal year. When 4.8% returns are compared to your benchmark, you beat the benchmark by 20 basis points. When they're compared to your peers, meaning $10 billion and up funds, you beat them by 100 basis points. So congratulations. We also want to thank you for your innovative efforts on infrastructure, including the important work and recent success with APG and the Infrastructure Alliance Partnership. Thirdly, we want to thank the board and staff for their commitment to sustainability and the hard work of figuring out how to best manage risk and opportunity in response to global climate change, long-term investing in a short-term world, and struggling with broad economic issues like economic inequality, economically productive investments versus extractive investments, and much more. CalSTRS is an important leader in these areas. You all have our sincere thanks and appreciation. We also want to address the issue of transparency of investment fees and costs, especially with respect to alternative asset classes. We understand that you have been working hard on this issue. It is astonishing and troubling that hedge funds, private equity, and many real estate managers did not fully disclose the complete cost of investing. We know all of you, especially Controller Yi and Treasurer Chang, have been working hard on this and urge your persistent attention until full transparency of all investment fees and costs become the standard of practice for all pension investors, their managers, and their consultants. We understand this will take some time. We understand there are concerns about being an investor of choice. We understand that some alternative assets deliver superior returns over time, and that's important to remember. And we know that costs matter. What is not measured is not managed. While net returns are clearly what matters most, hidden, secret, and need I say, embarrassingly high fees should be disclosed. We believe undisclosed fees and unreported fees are significant and a fiduciary challenge. We again urge you to lead in this effort through your work plans or a fee workshop or a consortium with like-minded investors to investigate and address this embarrassing risk that we believe is as yet unmanaged. Thank you again for your extraordinary work on behalf of California teachers and taxpayers. Thank you.
Thanks, Mr. Murphy. Appreciate that. I was just going to read a statement from I guess myself as the chair of the investment board, just to respond that our board is reviewing private equity reporting and accounting practices. I think the challenge for us is balancing our responsibility to achieve the highest return while being as transparent as possible. So as part of this process, we've asked our staff to look at the current industry standards on profit sharing arrangements, or what we've talked about today is called carried interest. Currently, staff can estimate with a reasonable level of accuracy the amount of carried interest its investment partners receive. But as a board, we want more information regarding this issue to follow up on the recent public debate. So we've asked staff to identify strategies to address these concerns and report back to us. So, thank you. And Ms. Yee?
Thank you, Madam Chair. I just want to thank Mr. Murphy for coming forward, and just want to assure him that we are definitely giving this issue serious consideration. I appreciated your statement, really identifying the complexities of really getting our arms fully around this. It is a complex asset class, but I just want to assure you that this board, and certainly Ms. Sendrick, your committee, is being very diligent about some of the concerns that have been raised. Thank you.
Thank you, Betty. All right, we are on to item 15, the review of inflation-sensitive policy for. Oh, sorry. Oh, I'm sorry. So Jennifer Baker. Sorry. It's a long day. I can't see out there.
Find me. Good evening, Jennifer Baker with the
Yeah,
California
really.
Teachers Association. I wanted to really echo the thanks for the board and particularly for staff's work around all issues. I think what's very clear from the previous discussions that you've been having about asset allocations and looking at long-term strategies, you're in a very difficult dilemma because you want to mitigate risk. You want to ensure that we can achieve very successful returns, which is why we always give Chris Ailman and his team an absolute A+ on these issues and appreciate the information that they provide to you to help those conversations. We are very interested in engaging on these long-term discussions about what's happening regarding private equity. And I think what's very important is to take this into context that we have many different short-term conversations happening at the same time we're trying to put together a long-term plan. And we would like to just remind you and remind everyone that we're working with that we want to make sure that wherever we're going to do, it's going to work for the long term, and that we don't wind up doing something in the short term that we think might help that could actually hinder some of those long-term outcomes. So I want to just thank you as you begin those conversations, and particularly to thank Chris and his team for the great work. We have absolutely 100% faith in the work that he and his team does on this. Thank you.
Thank you, Jennifer. Appreciate that. Thank you. Am I good? Am I clear? Okay, great. Thank you. Item 15, review of inflation-sensitive policy first reading.
Yeah, I'm going to jump out. Paul Shantic is not here. I'm sad to report that his mother passed away the beginning of this week, so he is in Arizona with his family. We adopted a policy for infrastructure, which is a part of inflation sensitive, but we did not adopt policy for inflation sensitive overall. So Paul is the director of that area, and he crafted a policy. The key thing I would highlight is, so it's a new policy. It's a first reading. If you want to make changes, we can bring it back in November. If you like the policy, we can adopt it now. It's up to you. There are two key parts to infrastructure, or to inflation sensitive: the infrastructure part, and then the TIPS, or we call them global linkers. They're only TIPS in the USA. Stephen is modeling commodities, and we could come back to you in the future and add that in, but right now it's mostly going to be focused on these two areas, and it really has two goals: one, to diversify our portfolio, and the other, to invest in things that will help protect us from inflation. Now, if you adopt a different asset allocation mix, PCAs has kind of an inflation bucket with a bunch of things in it. Makita is more pure infrastructure. We would adjust this policy based on however you adopt your asset allocation. The value to this is it sets up for us right away key limits for the auditors in terms of trading, the benchmark, what are the daily ticket size. So Michelle and I and Dilo are available if you have any questions.
Any questions about this item? So again, we can adopt it today, or we can move on for a second reading. So I've got Frank and then Paul.
And then also, the memos points out that it doesn't supersede the infrastructure policy. That would be inferred by reference, correct?
That is correct. The infrastructure policy, and we have that where we have sub-policies within an asset class. This just overlays that. Infrastructure policy stays in place.
Okay. Thanks, Frank. Paul?
So I have a couple of questions. So the public inflation sensitive would include investment grade and high yield bonds or securities that are described as short-term fixed and floating rate debt and loan securities. Explain why it's short-term is long-term in a different asset class, or do we just not look at long-term fixed rate?
Paul's looking at where we think that people will issue inflation-sensitive securities. And we don't, he doesn't believe at this point that we're going to see at least an investment grade and some of those inflation-linked type of securities. So he's, any of these, the high yield, any of these other securities that would be available to the public have got to have some linkage in their indenture to inflation or to provide a link to inflation.
So I guess the question I have, and I'm looking at INV 293, is there's A, public, inflation sensitive, and then under that, there's five specific categories. One is inflation-linked bonds. So then if are 2 and 3 not inflation-linked bonds? That's what I didn't understand.
Yeah, no, we probably should have said, the term inflation-linked bonds deals directly with just being government. We probably should have said government inflation-linked bonds, and then inflation-linked corporates, high yields, or other products.
Okay, that's what I was
Yeah.
confused.
The first category is government issued, either U.S. or foreign government issued, but they all have to be inflation-linked.
Third would be corporate or non-governmental,
Correct.
but still inflation-linked.
Correct.
And therefore, because they're inflation-linked, they're not likely to be long-term.
Correct.
Okay. And then a couple of pages later, there's a discussion of derivatives. Why would derivatives be a part of this asset class?
We're seeing quite a few cases where people are willing to issue swaps or over-the-counter agreements to swap out inflation, where we'd be able to buy inflation protection in that kind of a structure. It wouldn't be it wouldn't be typical things like indexes or other types of swaps. It would be only things that would be inflation linked. Those have been coming out of, which is interesting, some of the corporations that are willing to, in essence, sell somebody else inflation, and they're willing to take the risk on it. So we wanted to be able to have that flexibility. We don't anticipate that being a large part of this portfolio, but at least an availability in the program.
So how do we measure that then when we say that a certain percentage of our portfolio should be in inflation sensitive? Do we measure it by the notional amount of the swap, or how do we? I mean, there's no dollar amount. There's no dollar investment in.
No,
the
yeah,
swap.
we show it as the notional value in terms of the exposure. That's why if you'll notice, I often will show you charts that are as allocated, and then I'll show you charts as invested, because the as invested picks up that notional exposure. In other words, for the rest of the board, when you buy a commodity, you only have to put, say, 1/10 the price up as dollars, but you control, say you put in $10, you control $100 worth of corn. So we'll want to represent the notional value so that we're picking up that large value, which is, okay, we have that economic exposure to it. And if you want, we can clarify that better, or put a limit on the amount of derivatives in the
No, I
policy.
don't have a. I mean, if that's, I didn't understand what the derivative was.
We
and so
have
that
found.
explains it.
Gotcha. We found that the ability to use these, just like you asked earlier, of June in global equity, the ability to move out of indexes and move money around, we can affect the economic exposure immediately using derivatives in large dollar size. I often refer to these as power tools. Then we can take our time to do it in the actual physical markets later on. But that way we get the system exposed immediately using a derivative. It wouldn't be our intention to stay in those for a prolonged period of time. It's just a management tool.
Then my other question was about leverage. Leverage at the aggregate inflation-sensitive portfolio level shall be no higher than 50%. Sort of trying to understand that. It almost seems to me like leverage exposes us to inflation risk. I'm trying to struggle with
Do you
that
mean
one.
that owning by leveraging, we're gaining?
Well, if you borrow at a fixed rate and inflation changes, you're not protected against inflation. You're hurt by
Yes.
you're affected by inflation. So if what we're trying to do is hedge against inflation, wouldn't we want to say if we do leverage that we have to do leverage that's at a rate that's indexed to inflation?
That's a good point. The intent is not to constantly apply leverage. It was, Paul, I think, was looking at having clear limits within things like derivatives and the sub-asset classes of having a limit. But that's a good point. I don't have a good answer for you because I didn't talk to him about that point.
Looks like Alan might have an answer.
Oh, go ahead, Alan.
Mr. Amkin.
If you're a borrower, you're paying back in cheaper dollars.
No, I
So
know
in
that.
fact,
You're on the other
leverage
side
is,
of it.
you're on the other side of that
Right.
trade. You're not in the
Right.
wrong side of
No.
that trade.
No, I know. So if you're doing leverage, maybe you're offsetting. But what I'm saying is, our inflation policy doesn't allow us to invest in anything other than inflation-linked assets. So borrowing at a fixed rate that isn't inflation-linked is only a hedge if we, on the other side, are
No, what it does, it magnifies the impact of the inflation sensitivity, because you'd be paying those fixed rate debts with inflated dollars, so they would in fact benefit along with the rise in the underlying asset, which is linked to inflation. So it magnifies the inflation sensitivity of the portfolio.
in an inflationary environment.
Right, which is what it's designed to do.
Right, but I mean, it can work against
If
us.
rates go the other way,
Yeah,
absolutely,
then it-
that's not a
I mean, so
riskless
it's
trade.
It's just leverage.
That's exactly right, just leverage, but in this case, it goes in the same direction.
See, it seems to me, okay, as long as it's well managed and used for the right
It's like any other
purposes.
form of leverage.
You wanna-
I know it
Leverage
is, I know it is,
football.
I know it is, but that's what worries me is, you know, generally and we've had conversations about this, generally, we are not we have not pursued an investment strategy that explicitly says, let's borrow money to invest in the stock market, basically, right? I mean, so,
With the exception of your real estate and private equity portfolio,
well,
both of which are leveraged.
I mean, we can go, but, yeah, I mean, we haven't done pension obligation bonds, for example. So,
Thanks.
thank you.
Are you good, Paul?
Yeah.
Okay. So again, we can move to approve the policy or wait. What's the will of the investment committee? Entertain a motion. Do you want to accept? Everyone awake?
I would move approval, assuming that no one had any suggestions. It didn't seem
Right.
like any question
Nothing was
Right.
resulted in a
Okay,
change.
so moved in second. Any discussion? Those that are, all in favor, say aye.
Can I just say
Sure, absolutely.
that there is going to be that clarification made about the first question I asked, right?
Oh, yeah,
okay.
correct. On
That'll just,
INV, we'll add that into INV 293. We'll add the word inflation in front of 2 and 3.
Great.
Item 2 and 3, yeah.
yeah, okay, thanks.
Good, thank you, Paul. Yes.
Oh, so we're gonna vote on that, right?
So we are just in the middle of voting. So all those in favor say aye.
Aye.
Opposed? Abstentions? All right. It is,
Sure.
tell Paul Shantic it is approved. Yes. That's good.
I don't know, who puts the photos together? That's a beautiful picture on
know.
that. It's really, it's a beautiful
Communications
picture.
creates these slides.
Yeah, that's a great photo. It's really beautiful.
Speaking of PowerPoints, I do have to say, if, I don't know about your eyes, my eyes are like 40 something eyes now. If we could have the presentation, some of the text on a lot of them is really, really small. So if you could just make 2 slides and split the information, Steve, Makeda, a couple of the different slides were just, they're really, it's different reading it as a board member in a book. It's hard to read it up there, or even on our monitors here. So if people could just make the PowerPoints 12 font, 14 font, or whatever font, would be a little bit easier to read, that would be great. Until we get 20-somethings on the board, I think we're gonna need
Yeah.
to get big font on there. Great, okay, thank you. Let's go back to item 7, and then we just had a couple more items in open session, and then we will head into close. That's the private equity consultant, contract terms and conditions. And we had, Chris and I had a conversation around this. I think how the item was written is a little bit, well, let's just talk about it. A little bit different than, I think my intention with this item was for us as an investment committee, we've been having a lot of conversations about consultants, the role of consultants, what do we want from our consultants? How do we want to pay them? How do we get the best value for what we pay our consultants? And so in our October offsite, I know we are going to have an item on the second day, correct? On the second day? I can't remember. But at the October offsite, we're going to have a conversation. And my hope, in talking with our board chair, Harry, that at the October offsite, we as a board will have more specificity about our expectations. What do we want? What are the 3, 4, 5 things we want from a consultant? What does it look like for a consultant to meet our expectations, to exceed our expectations? Do I sound like a classroom teacher right now? It sounds like a rubric to me. And so we haven't done a very good job, I think, as a board of being clear about our expectations for consultants. So we're going to do that in the October offsite. And my intention is for that to be not just on our private equity consultants moving forward, but all consultants, that we're consistent with how we treat all of our consultants moving forward. So in this particular item, I know in June, Chris reminded me, the board, we had a conversation around some different ideas. And so my intention with this item was for us, obviously with our new private equity consultant coming in, Mr. Haggerty from Makita, we had a conversation in June about how we were looking at that structure. How it came out in the write-up is a little different than what I was thinking, so I was hoping maybe we could just have a conversation about that item and as an investment committee decide how we want to move forward. Is that fair, Chris?
You bet.
Okay.
I was going to say, I think, this is an idea you guys proposed. We negotiated it, but it's open for change. I think legal counsel Harvey and Jack and I raised some implementation challenges we saw with this and maybe some more ramifications than we originally thought of when we looked at this structure. So you're open to do whatever you want. This is, Makita's agreed if this is what you propose, and if you want to do something different, then we will sit them down and go at it. Part of the challenge we highlighted was you have to outline your expectations, which was a challenge, and then you got to figure out how to vote each year. One of the points was these are 30-day termination contracts, so if at the end of the first year you're not happy with the performance, it's baseline or below baseline, you can pay them their salary and then terminate their contract. And that's probably the most powerful thing than just proposing a fee reduction.
And I'll just add, and I think Mr. Keeley has input, is in the past and what I've seen with other institutional investors and boards, you hire a consultant and then if they don't perform, you fire them. That's sort of how in the past, I think as a board, I think our conversation has been, can we give more, can we be more clear at the initial hire of our consultants, here's our expectations for meets and then exceeds and, doesn't meet. And then is there a way that we can tie compensation to that? And so I think that was the intention. We'd like to get to that place. And so we're moving towards that. So Harry?
So I'm a little bit reluctant to get too much into the details of a employment contract in this setting.
Right.
So having said that, I do believe and I know that those agreements clearly outline what the deliverables are. And they clearly outline that the advisors work to support our board. This whole concept of how the compensation mechanism is set up within an agreement, the specifics of which I don't think should be discussed at this time in any detail. But here's something I would like to suggest, and I would welcome some staff guidance and/or if we can be if it's available, we don't have to recreate the wheel. But there's also known as guaranteed minimum contracts. You're guaranteed a certain base pay. Guaranteed. You essentially show up and you do your job. And then there's what's known as incentive or unguaranteed pay. And I would like to look at a model along those lines. So that going into the agreement, the advisor is fully aware of what the base pay would be. And we then evaluate at the offsite. We do our evaluations, generally that's when they take place, of our advisors. And at that point, we can review the criteria, what the deliverables were, and there would be a maximum pay. It would be a range. This is your base. You can get up to this amount if the board decides that's what you deserve. So that's about as much of the details I think I want to get into here in this setting. I think there's a lot of challenges with the three proposals that are there.
Right.
It's-
Yeah,
Right.
yeah, no, I agree.
I think
And that may
that's a
create
great-
more problems than they'll solve.
I agree. You certainly can do that. You actually, I would say, I'll take liberties. I think you have practical, hands-on experience with doing that with Jack and I. You know, a smaller part of our incentive is subjective, but the challenge that we found with this and trying to figure out a formula for you to judge them and rate them is that this is a professional service. It's highly subjective in its nature. It's very hard to quantify and measure it because they don't pick the investments in the portfolio. Like Dr. Yetman, they're providing you with guidance, but they're not doing the physical work. So it's hard to figure out how to measure it. And we certainly could propose that. I think it'd be good to go through the pros and cons. So like, you know, when we developed this, we didn't have time to really think about the ramifications of how this worked until we negotiated it and realized both sides had issues and challenges with this. So we certainly could do it. I think I would just have you reflect upon the challenges the board's had in the past when just doing that with your own staff of trying to figure out, okay, we got a base pay. We think generally we've used incentive pays in all parts of the portfolio with the managers. We think it aligns interests and creates motivations. It's just hard to measure. Sure. So we can certainly do that in this case. The existing contract for Mike expires at the end of this month. And the only part left to negotiate with Makita is the fee schedule. Given that you're not going to talk about this until the board offsite in October, just a recommendation as an option, you could enact a one-year contract or a contract with Makita. You would have the option to terminate at the end of a year. And then with the ability to rewrite the fee schedule next year at this time, once you figure out how you want to, you could even do it a 6-month interval, but how you want, you know, when you figure out with your consultants, if you want to move a lot of them to an incentive-based structure like that, we could go back and renegotiate that fee schedule.
Okay, I've got Paul.
Harry, how is what you're proposing different from what's already in here? I mean, what's in here right now is guaranteed 60% of the proposed fee. They can earn up to 100% of the proposed fee. How is what you're proposing different from this?
It's slightly different in my thinking. I would start with a base of a little lower than that, and then I would clearly have, I think the measurement instrument needs to be fleshed out a little bit better.
In terms of
I don't
expectations, you mean?
yeah, and I think it would be clear about when that evaluation would take place. I don't think it's necessarily clear how that, in this write-up. I think it's similar, Paul, in concept, but I think the details aren't fleshed out well enough. And I think to try to flesh out those types of details in this setting with the number of people that we have around this dais, I think it makes it complicated. So I think it's close, but it's not fully where I think it can be.
So
It's similar.
I would, I mean, I think we have a problem asking people how much they will charge to do the work we've asked them to do, and then to tell them, well, we want to hire you, but we only want to pay you half of that. And you have to exceed expectations to get what you've asked. But that's a separate question. I think and maybe we can discuss that in October, but I think we have to make a decision now. So given what we've heard, which is that, you know, on 30 days' notice, we can terminate this contract or any other contract, I would recommend that we that we enact this contract for a one-year period of time, recognizing we could cancel it at the, October offsite effective, 30 days after it takes effect. And I would suggest that we do that one-year contract at what Makita bid. And if we don't like them, then we get rid of them. But if we're gonna spend a lot of time, so there's no upside for them, they can't earn more, but they can't earn less. And if we don't like them, we fire them. And then that's for 1 year. So, I would like to suggest that as a way to move forward, but if the board chair has a real problem with that,
No, it's
I won't
certainly
make a
it's
motion.
certainly something I can live with. I mean, you make
Yeah.
some valid points. We have that discretionary authority to make a change. You make some very valid points. And I think there's a broader, more nuanced conversation that needs to take place around the whole, what we allocate for consultants, what we expect, what's the value add that we're getting that's better suited for a conversation at our offsite. I think it'll be a richer conversation. We'll probably get better outcomes. So I certainly can live with, let's do this for a year and see how it goes. But I think that we could direct our staff on a going forward basis to better align the interest between the consultants and the board and our system. Better align those by doing something around incentives, which there's some motivation. Essentially incentive pay. But that's for broader conversation. Short answer is I can live with this for a year.
as proposed in this,
Yeah, I can live with it.
with this
Yeah.
60, 80,
Yeah, I
100?
can live with it.
Or just 100?
So you're, I
On
want to make
what
sure
they
I'm
bid.
understanding
On
what
what
Paul's
you-
saying.
On what they bid.
When
On
you say
bid,
what
I
they,
can live with
Okay.
it for a year.
Okay.
I can live with it.
And so I would assume we're
gosh.
probably not going to have a lot of renegotiation with Makita about whether they're willing to, unless they don't want to sign only a one-year contract.
so can I clarify, you guys? Because I
Yeah.
need my brain to keep moving here or I'm going to lose it. So they've already agreed to the 60, 80, 100, correct? Or no?
Yes.
Or we're still in negotiations or not? Okay.
You're still in negotiations, but we've twisted their arm to agree to this
And I
at
realize
this
it's
point.
awkward, but you're proposing just 100%,
I'm proposing
right?
a way to get us
Right, so I'm just,
to adopt it.
but I want to clarify that
Right.
you're saying, are you basically saying the 100%? Or are you saying this 60, 80, 100? I guess I just want to.
Either one, I would just
Okay.
like to act on it today.
Yes,
mean,
I agree.
So if it's,
Okay,
One
Chris?
small point of clarification, I would recommend your motion be that the fee schedule have a life of 1 year. That way you can renegotiate that, because under our rules right now, if you eliminate the contract, that'll throw you into a whole RFP process, which sadly will take some time. So adopt you already picked them as a successful winning bidder. Say that you want to approve a fee schedule for 1 year, and with the option to renegotiate that. You still always can terminate, but the option to renegotiate that should you choose to
I've got a
change
couple
the structure of it.
folks in the queue. Let me grab Betty and then Arena.
Chris just answered my question.
Perfect.
It's the fee schedule.
Great. Arena.
Point of clarification on the 60, 80, 100 versus giving them the contract at what they bid.
Yes.
One of the things in the discussion is that we don't have a process for evaluating
Right.
the 60, 80, 100.
That's
So
my-
I would
that's
not
more
be
my point.
comfortable adopting the 60, 80 policy here, contract, when we don't actually know how we would evaluate it. So I'd rather go with Paul's, I don't know if that was a suggestion of a motion of
original
just
was
doing it at the
100%.
bid. We can reevaluate how we want to do it going forward, including a mechanism for how we would determine.
Thank you, Arena. Appreciate that.
And I'll,
Okay, that
and I'll,
motion?
and I'll second that motion. Because
So-
if this was to happen to an educator, and you didn't
How
have
are
the
you
criteria
evaluating
to
me?
come up with 60, 80,
How-
100,
what's the
we'd file a
criteria?
grievance.
I agree.
So.
And
we're
we
not
both
gonna-
have
we're gonna-
experience with
we're gonna
that.
be- We're going to be
You don't wanna mess
consistent,
with us
at
on
least
the
in this
grievance.
point, we'll be consistent.
So can we just be clear on the motion?
To approve the contract
100%.
at the bid, if that's the 100% on there, then that's what it would be, 100% or at the bid or whatever the words you want to use.
Right, I just want to make sure that we're using the right language, so it's at the 100%.
I think because you're not approving the contract. They were the successful bidder. You're approving a fee schedule at the bid for 1 year with the option to renegotiate.
Great. It's been seconded. All those in favor say aye. Aye. Opposed? Abstentions? It is approved. There you go, Makita. And then, again, this is all, hopefully, and please help investment committee in October. My hope is, because I know I'm one of the ones who's brought up this consultant issue, that I really would love to have, like, if we could make a rubric or something, or, have clear expectations on, because I know we vocalize, even though it is subjective, I've heard us talk about what we want. So I think for this iteration of the investment committee, it behooves us just to have clarity about what are the 3 or 4 things we want our consultants to do, and if they don't do them, then that's gonna help us figure out, how to continue to engage consultants and utilize them, because we wanna get the best value we can from them, so, thank you. All right, we are back to item, review for information request. Lamont, have you kept track of all of our iterations?
Done my best.
Okay.
Let's see here. So I have 3 actually regarding item number 5. The committee requested the tracking of the decline of fossil fuels as a proportion of the overall market over time. That's out of the CIO's closed session report. Regarding item number 8, the committee requested that in the next CIO risk report that there be inclusion of sensitivities to significant external risks, including but not limited to oil and fast or slow rising interest rates. And regarding item number 10, the committee requested that the consultants provide additional information and modeling where RMS inclusion in the asset allocation does not work.
Okay. Anything else? Good. Thank you, Lamont. 17 is our draft agenda for our November meeting. Are there any changes, Chris, given our conversation today and items?
There we go. I just wanted to highlight 2 things. I had estimated the asset allocation at 90 minutes. I think we definitely want to make that the big key thing on the item so that you're fresh and ready to go. We probably won't be ready to adopt number 10, the new policy. But if we are, we'll be ready to come back right away with it. The 2 things I wanted to highlight for you, number 12, Sharon and Paul have asked us to develop an investment cost report at the staff level using our own methodology. So we're hoping to come back to you with some ideas that maybe in the future we could kind of promulgate a CalSTRS standard of here's how we're going to define investment cost, and then let the industry decide if they're going to, how they want to react to that, if they believe it or not. And then number 13, I want to make sure you know this dovetails in with what you're doing in the governance committee for the board, where the governance committee is looking at different reports, which ones to keep, which not. We're going to do a deep dive on the investment one because you get almost over 90 reports from us to make sure we know from a fiduciary standard what you need to get to monitor such a big, massive portfolio. What's quite clear already from the survey work that the team upstairs has done is a lot of it's all over the map on reporting and what detail people get. Sadly, there's no industry standard for us to adopt. So I think just like number 12, we may be setting a new industry standard and see how people react to it. But we're going to at least come back to you with some work with Harvey on ideas, because clearly you don't want to be overwhelmed with paper, but we also need to give you access to details. So we're going to try and make use, obviously, of technology, as we have done. iPads, videos, not just written reports. That day's gone past.
The only other thing I wanted to highlight, Chris, was our closed session, item number 6 for Nora and new folks, or just a reminder for you that today, we had a conversation with Deborah. I'm spacing your last name. Sorry, Deborah Smith, our COIO. But typically, we hold that as an item that if board members have particular issues they want to talk about around investments, that we can have a closed kind of session in the back, and we can bring anybody we want I know, Brian, barring, counsel and what it's about, but, anyway, I just wanted to let you know that's a standing item as long as we make sure Brian says it's okay. All right. Anything else? All right, I don't want to give you a heart attack on Wednesday afternoon, Brian, but, there's constraints on what we can have in closed session, that's why he was looking at me like that. Okay, draft agenda, opportunity for statement of the public, we've had those, anyone else? Excellent, great. So we are going into closed session, so those of you who are in the public, have a nice evening, enjoy your evening, and we'll see you bright and early tomorrow morning at 8:30 for benefits and services.